Traders, this is Emily Advani, your host for a special edition of NewsWare's Trade Talk. Joining me is our trading anchor, Bill Olson, and special guest, Steve Hill from AIQ Systems. In today's special podcast, we're going to review the market from a sector's perspective. It seems like now more than ever, being prepared with data-driven market information combined with technical analysis is key in navigating these choppy markets. Steve, welcome. You're a special guest today. Why don't you start off by telling us about AIQ Systems, and we're going to get into some analysis next, but let's hear about AIQ.
Hey, thanks, Emily, and thanks, Bill, for having me on the podcast. I'm Steve Hill from AIQ Systems. For the last 40 years, we've been providing technical analysis of the stock market, indexes. We also do mutual fund analysis. Using technical analysis is our primary tool. We're also an AI-based system, so we have one of the earliest iterations of artificial intelligence built into the software itself. One of the key areas that's made us popular amongst clients throughout the world is the sector rotation and group rotation that we provide within the platform. We slice the market up into segments, usually based on the S&P 500 sectors, and provide detailed analysis of trending groups, losing groups and sectors, and also an in-depth possibility of where each of those sectors and segments will be going. So back to you, Emily.
Steve, with this analysis, we just closed out Q1 here. We're starting off Q2 with a bang, with these latest announcements on tariffs from President Trump. We were down big in markets yesterday, and as I'm looking at my screen, continuing to tumble today. And this is why it seems important, not just during, good times, but during these unpredictable times, to have some sort of information at your fingertips that you can really hold on to, facts and technical analysis. So why don't we start by taking a look back at Q1? Steve, can you give us an overview of your analysis, sector-based analysis from Q1?
Yeah, so looking back at Q1 of 2025, the market was in an extremely volatile situation. There were some disparities brought about by various developments, both economically and geopolitically. The utility sector actually emerged as kind of the top sector within the S&P 500. Again, a lot of the demand was from electricity requirements from data centers and a sort of a trend towards electrification. And so that sector really did very well. The utilities, broke through their key resistance levels from 2024, and that trend seems to be continuing even at this moment in time. The other sector that was kind of leading in the first quarter of the year was materials. It had a sort of a slow 2024, but since then it's moved above its moving averages, and its relative strength sort of points to continuing at some point here a movement to the upside on materials. Of course, on the opposite side, I'm pretty sure most of us are aware the leading losers are technology. Huge headwinds within that sector. That's definitely the one at the bottom of our analysis report. And again, stocks, obviously Apple, Microsoft, Nvidia, significant stock declines. The triple Q sharply dropped. The sort of driver technically happened sort of towards the end of 2024 in the sector. You could see a double topping pattern with a definite divergence downside on the technical indicators like the moving average, convergence, divergence. And it was very strong selling pressure at that second top, which kind of gave us a forewarning of what was going to happen in the first quarter. And it looks like that may well continue to the downside given the current market metrics. The other sort of leading loser was the consumer discretionary, and this includes luxury goods. A lot of import stuff within that sector, within the S&P 500. Companies like RH that reported the other night saw sharp losses before, even before the announcement came out on earnings. The companies themselves, the downtrend is looking, pretty bad, and they're down below their moving averages, and it still indicates a bearish outlook. And by the way, the utility sector itself on the S&P is above all its major moving averages, even above its 21-day moving average as of last night. So it's still looking pretty good on that sector. Back to you, Emily.
And Steve, taking a look at Q1, looking at those buckets, Bill, I do want to turn it over to you now. That's sort of a recap of what we are looking back at Q1. And now we have another quarter to look ahead to that, as I mentioned, is going to be unpredictable. But you're looking at data and information as well. So over the course of the next quarter, what do you see, given this information in Q1 and what we have on hand today, as potential catalysts? And what sectors do we think there could be a benefit?
Yeah, okay, let me take a look. Oh, I mean, I understand what Steve's saying about the utility sector and the data centers, and that has been a popular trade over the last quarter. There's a story out today how Microsoft's pulling back on some of its spend on data centers in Asia. I I don't know if the utility sector is gonna be able to hold up. I suspect it will because it's a safe haven. It's a safe haven in periods of market volatility. But for me, I'm really keeping an eye on the healthcare. I mean, specifically the high dividend paying healthcare stocks. You know, the the market loves the high flying tech stocks. They always have. But with all this tariff news, you're adjusting your positions, and the yield trade has always been a crowded trades in periods of economic weakness. But it's safe. It's good because at the end of the day, you're receiving a good dividend, and you get price appreciation possibilities. Um, Not every so I'm looking at the healthcare stocks that pay a dividend. You look at something like Pfizer, PFE. I mean, it's yielding over 7%, 7.22%. Um, I don't pay any attention to that current probe that's going on about the possibilities that they may have delayed the release of their COVID vaccine until after the Biden-Trump election. I don't. That's not going to affect the stock. I mean, it's not true. They got it out as soon as they could, according to what I've read. But if I can pick up that stock, 2250, it's a gem. Johnson and Johnson is another one. They're yielding, they're yielding 3.10, 3.10. They do have that talc powder lawsuit going on, but this company has a lot of financial flexibility, which kind of mitigates any litigation pressures they have. And if I can get in 148-ish, it would be a good. It'll be a steal. Merck, hey, it yields 3.80. It's been clobbered. It's dropped. It's down about 20% from where it was trading last year. Anywhere around 80 is a good deal. And let's take a look at CVS. Charlie Victor Sam. I mean, it yields 3.97%. Financials have been improving since last year because last year they were really horrible, but they're getting better. Walgreens is falling apart, so CVS should hold up. And if I can get in CVS 55, I like it. You compare that, these dividend paying stocks, these high dividend paying stocks, where they're all over 3%. If you compare that to the average S&P 500 stock, the average S&P 500 stock yields 1.2%. So you're getting 3, and in Pfizer's case, 7 versus 1.2. I mean, and you're walking into an environment of higher tariffs and a possible recession. So high dividend paying stocks should really hold up. And there are a lot of dividend funds out there. And what do these guys do whenever the market pulls back? They're buying the dividend funds, and they're buying more of this dividend stock. So yeah, I do like the healthcare sector, specifically the high yielding dividend stocks. The other sector I like, the grocery stores. It is a tough business, but grocery stores have historically demonstrated resilience during economic downturns due to the essential nature of their products. I mean, grocery stores fall under consumer staples, under that sector. This is things like food and beverage and household products. But these items, are in demand regardless of economic conditions, and consumers will kind of be prioritizing their dollar spend, but they're always going to be going to the grocery stores, even during, economic contractions. So I like that sector. And there's a couple stocks in the sector that I do like. I mean, Kroger, Walmart, Costco. I mean, these are the ones in focus for me. I mean, Kroger, 62.50. Walmart, I think could hit 75. That's a screaming buy at 75. And Costco, I mean, 8.50. If you can hit that. I mean, remember, Costco doesn't change their margins. They do 15% margins on anything, on everything they sell, and people love Costco. I mean, they that those stores are typically overshopped, but they have they have the volume. They're good, solid companies in a business that's not going to really hit a downturn because of the tariffs situation that we're under. But that's kind of the two sectors that I like most for the next quarter, Emily.
Bill, I'm hearing from you, that sort of news-driven themes and facts, specific stocks within the healthcare sector, as you mentioned, and grocery stores. So, Steve, I'm going to turn it back to you. Let's take a sector step back. Bill mentioned healthcare and sort of the grocery food sector there. What do you think about those opportunities in the upcoming quarter?
Yes, Emily, it's interesting, the healthcare sector itself, especially on the S&P. Obviously, encompasses a broad range of health-related stocks. The price chart itself is actually holding up pretty well. I mean, there are segments within the healthcare sector that have taken a big hit, but right now it's actually testing a a support level actually for the third time, and it seems to be holding up pretty well. I've also looked at the money flow, which is a measure of the buying pressure or selling pressure within a given sector or even on a stock. And in the healthcare sector, there has been some pretty good money flow going in, even though the sector itself overall hasn't been moving up very much. So there's definitely a possibility here when we've come back down this third time to this support level and we're holding there at the moment. On the grocery sector, as Bill mentioned, is part of the consumer staples, which is when you look at the S&P consumer staples, it is above its 21-day, 50-day, and 100-day moving average, which is good. It's actually been traveling along the 21-day average for a few days now, which is also good. As we know, it's not the world's most exciting sector when you're looking for big moves, but it is a safe place to be. We know consumer staples, we know groceries, everybody has to eat, and we know it's a tough business, as Bill is saying. But technically, there's money flow still going into this consumer staples sector, and it is definitely above all three moving averages, and that's been above there for the last 5, 6 days. It's been above its 21-day average. So overall, that's a pretty good sign. Back to you, Emily.
A safe haven definitely feels like a win right now. And Bill, I did want to also ask, so if we're looking at healthcare and possibly grocery stores, and Steve's analysis, backed that up, anything to steer clear of, anything that's a clear loser that you see in your book, Bill?
Anything that I see is a clear loser. I mean, it really, there's so many factors going on right now. I mean, it comes down to what happens with the tariffs. It comes down to what happens with the Federal Reserve. Now, Jerome Powell is going to be speaking today at 11:25. He could actually help calm the markets a bit, because I see talk of 4 interest rate cuts this year. I mean, if you remember the dot plot that came out in December, they were talking too. That was reiterated in March. And now, because of the tariff situation, the odds of additional rate cuts are getting higher. So that could help the market. But listen, I don't want to be long tech at this point in time because it's just too volatile. I don't want to be long, retail, because retail is, you think of something like Lululemon, where it's a Canadian company and they develop their products in Vietnam. Are you kidding me? They're going to be hit with double tariffs. I don't want to. I would want to really be staying away from retail. So that's kind of, tech and retail are not on my fan favorite list these days, Emily.
And Steve did mention, in Q1, tech was one of those leading losers as well. Steve, what do you think in terms of sectors that may take the biggest hit moving into 2Q, given the number of factors that Bill mentioned that, we aren't really in control of, but we can sort of control the data that we're looking at? What are you seeing in terms of tech or retail for Q2?
Yeah, I think the technology sector will be under pressure as well. There is some mention of the tariffs perhaps coming from overseas. that will affect digital services, and that would be a huge blow for the technology, which is our major export from this country. The tech sector, so I would be very cautious in that sector itself at the moment. The consumer discretionary, again, with the luxury goods and other products in there that are sourced from overseas, that's another area that's going to take a lot of beating, I think, given the current tariff war that's going on. So, I don't see a lot happening there. The healthcare was really, really interesting. The healthcare definitely doesn't go away. I mean, no matter what happens, we need healthcare, and we're all getting older, and it's an aging population. So that sector, I still think is going to hold up. There'll be pockets in there that will do really well, and pockets that won't do so well. So it's a pretty good sector to be in. And as Bill was saying, the groceries are good. They're good. I mean, there's a great number of grocery stores out there. There will be a lot of uh, moving around on some of the products in grocery stores where they're sourcing them from, but we do have, especially when I'm out in California, we do have a very large source of agricultural products that also feed into those grocery stores that are domestically sourced. So yeah, so both of those areas I think are looking good. Back to you, Emma.
So I am hearing from both of you, keeping an eye on the healthcare sector, grocery stores, really being cautious around tech, luxury, retail. So we will keep those in mind. But before we sort of wrap up today, Bill, I'm going to toss it to you. Is there anything that we haven't talked about that you think is worth mentioning?
Manufacturing. I mean, I got to be cautious on manufacturing here in the States because, automobile plants, you saw what happened with Stellantis this morning. They came out and they said that they are ceasing production of automobiles in Canada and in Mexico. That's additional manufacturing that's going to be slowing. So the automobile sector, I think, is going to slow. The used car automobiles, I think, will continue. Will have a resurgence, but new car sales are likely going to be challenged. Manufacturing overall, we're just not a manufacturing country as we used to be. Those plants have gone away. Those plants are turned into residential housings. A lot of them have gone away. So we can't really turn the dime and become a country of manufacturing. And you look at the latest PMI data, and it was weakening. So I'm really cautious on manufacturing and automobiles. For the rest of the year, Emily.
Another note to keep in mind there, Bill and Steve, what do you think? Anything that we haven't gotten to today that you think is worth mentioning?
Yeah, the only other thing I looked at technically was regional banks, which is subsection of the S&P financials, was looking pretty good. And those
Yeah.
banks are kind of that they operate in their own environment, serving their local markets, and that's been holding up pretty well. I looked at the financial sector itself as of yesterday's close. It was doing a similar thing to what the healthcare sector was, which is testing a support area, and it's hit it the third time. Today, we'll see how it goes given the market's gone down. If it breaks through, then, things may change. But, the financials are sort of hanging in there at the moment. Be interesting to see what happens with interest rates.
So I hear that, no matter what the markets are going to hand us over the next few days, the next weeks, even the next months, it's clear that having access to data, information, professional newswire, technical analysis is not only key in finding opportunities, but really mitigating risks. And that's what both NewsWare's Trade Talk can provide in our podcast. We can also provide that in our professional newswire. And Steve, with your AIQ systems, combining these tools really, give you an informed look at the trading day, weeks, and months ahead. So I would like to thank Steve Hill, our special guest from AIQ Systems, for joining us today. Thank you, Steve.
Thanks, Emily. Thanks, Bill.
Thank you.
And if you would like to learn more about AIQ Systems, go to www.aiqsystems.com. And Bill, thank you also for joining us today and continuing to share your expert insight. If you want more about NewsWare, go to www.newsware.com. Thank you, Bill.
Anytime.
Again, I'm Emily Advani, your host at NewsWare's Trade Talk. Traders, you know what to do. Let's go out there and make some green.